So what is the best options expiration date for your overnight swing trade? Well, let's start off looking at the numbers. All right, so let's look at some SPY option chains. And we'll start with SPY 3 days out. We go down to just in the money. The difference between 442 and 441 is 327 minus 266 is 61 cents. All right, let's look a little further out. Let's say 7 days out. Again, the difference between the 442 call and the 441 call, 384 minus 324 is 60 cents. Now, why are we subtracting these? Because this is a nice approximation to how much you will make if there is a dollar move in the SPY. Let's go further out. Let's talk 10 days. And the difference between 468 and 406 is 62 cents. So as you can see, these numbers are all the same. Now it does increase and it does change a lot further down. Let's go 30 days out. Here the difference is 66 cents. And if we go about a year out, let's take a look. The difference is now $39.29 minus $38.60 is $1.38. So it took a good year for that to double. However, look at the premium, $38.60. So if you divide $39.29 by $38.60, you get 0.0178%, almost 2%. Let's go back to the 3 days. 3 days out, divide the 327 by 266, and you get a 22% gain if the stock moves $1. There's a big difference between 2% and 22%. If the stock moves $2, which it very well could, you would divide $3.94 by 266, and there is a 50% gain, actually 48% gain if the stock just moves $2. However, if we go back at the other end, you might get a 3 to 4% gain. So let's talk about what this really means when deciding which options contract to buy for the next day. So as you can see, there are a number of things you need to consider. And the thing is, with options, when you gain an advantage one direction, you end up losing opportunity. You gain opportunity in another direction, but maybe you lose a little advantage. And you need to find a balance that fits well with your risk tolerance. So as you can see in those examples, the closer you got to expiration, the lower cost of those options. The premium was less. So that 60-cent move represented a higher percentage gain or loss. But there's also another disadvantage. Those premiums are going down quicker because of theta, time decay, which means by the next morning you're already going to lose some money, which is a little bit different in compared to options which are further out in expiration. So if you have an options contract that is much further out, you'll have less theta decay. So in other words, the premium that you put in at the end of the trading day will probably be very similar if the market opened flat the next day. Unlike an expiration date that is 3-4 days out, you're going to be underwater if the market opens flat. However, those longer-term option contracts also have much higher premiums because you have more time for your option to stay or go deeper in the money. In other words, your options contract has more time to keep or extend its intrinsic value rather than expiring worthless. So obviously, we need to consider the risk and reward based on our goals. And there are a number of factors we also need to consider, such as volatility and how volatility will affect our options trade. Because if volatility is increasing, we could actually make more money. However, if volatility is decreasing, especially during those short-term option contracts, we could lose money even if our indicator was right. We see a SPY contract just a couple days from expiration. and the premium is only $1 or $100. And we see in the option chain that a dollar move in SPY would equate to 60 cents or 60% gain overnight. So overnight, let's say it did go up $1. Well, chances are you're not going to get 60%. Due to theta decay, overnight, you may end up with, say, 40, 45, or maybe 50%. However, that's much different than if you bought an option contract many weeks out. So let's say you buy that contract, it's a number of weeks, if not months out, and you find that the premium is $10, which equates to $1,000, compared to the $100 for the short-term contract. But that's because you have a lot of time on your side. However, that overnight move is still the same. It's $1. And that increase that you'll gain was still 60 cents. But 60 cents on $10 is 6% compared to the 60% with the shorter term contract. And as I mentioned before, those longer term contracts, they're not hit as hard by time decay. Theta is not going to eat away as much at your profits overnight. We saw that 60-cent move, which by morning with a longer contract could still be worth 57, 58 cents, unlike those shorter term contracts, which could lose 5, 10, even 15 cents just overnight. But again, the longer term contract makes 6% and the short term makes 45, 50%. And of course, you can measure those losses the same way too. For me, I'm rather aggressive in my trading, and I tend to look at expiration dates of 4 to 7 days out. If it's a weekend or a long holiday weekend, I may look at 7 to 10 days out. And these tend to bring the returns that I'm looking for. It is important to remember that there are 3 parts to making up the options premium. And we've focused on 2 of them at this point in time, and that is the underlying price or value of the asset. What is the current price of SPY? The other one is the time frame. How long until expiration? But the third one is also very important and something you need to consider when buying options, and that's volatility. Is volatility going up? Well, that can be in your favor. Or is volatility going down? Well, your indicator could be correct, but you could still lose money if there's not a big move when volatility is coming down. My recommendation for you is to do a personal risk assessment. Understand your risk tolerance. How much could you stomach losing overnight? 0.5%, 1%, 5%, 20%? Understanding this will help you decide what type of options contract you buy. How many days until expiration? How far in the money or out of the money is that contract? In other words, how volatile might that contract be? But also understanding your position size. How much will you risk overnight? Can you risk 1%, 5%, 10% of your portfolio? And when I say portfolio, I don't mean your general retirement portfolio. I mean your high risk portfolio, which should only maybe be 5 or 10% of your overall portfolio. This is your high risk portfolio. This is the opportunity for you to make money that you've always dreamed of. But you also have to do it in a way in which you can sleep at night. And of course, if you're looking for a signal to help you decide whether you should buy calls or puts overnight, head on over to spytomorrow.com for the free signal that's available at 4 o'clock Eastern Standard Time. And I'll see you in the next video.